All right, guys, welcome back. So for any of you that are new here, my name's Tony. My wife, Missy, and I achieved financial independence in January of 2025 off a very small portfolio. Now we have multiple ways that we pay our bills. We have zero debt, and I'm just going to walk you through our taxable portfolio. So this is the portfolio that we're using to generate cash to spend. All right, we generate cash to spend on this portfolio two different ways. The first way is through extremely aggressive, high yield dividend distribution funds, whatever way you want to put it. The other way is we actually use that portfolio, we borrow against it using margin, and then we sell options. This generates a completely second amount of cash, and we put the two together, we reinvest half, and we take the other half and live off of it. We are currently doing this on a portfolio of under $125,000. It moves up and down based on the market. Right now it's a little down, as I'm sure all of you can see in your portfolios. So let's get into the whole thing. We'll lay it all out and explain the whole thing to you guys. All right, guys. So now that we're in the tablet here, I use the dividend tracker just to make it easier to show you guys, because we have this in two separate Robinhoods and one account over at Fidelity. Now there'll be links for everything down below this video and in the first pinned comment. So if you want to go check out the dividend tracker, if you want to check out our actual portfolio on the dividend tracker, which also includes our growth and anything else, it's all going to be in the first pinned comment or in the description box. Now, currently, as we're looking at this, the total that we now hold is $115,609. Now, this has been as high as $127. It generally floats between $120 and $122 on most times, but as you can see, we've been in a little bit of a dip here lately. Now, I want you to understand that these dividend trackers have a really hard time with some of the funds we're in. In fact, I don't know any of them that get the yieldmax stuff right. Now, none of this is financial advice. All right, we're just explaining how we're doing it, showing you guys how we do it, and nothing more. This is a very aggressive approach. I would not suggest it for most people. Now, this portfolio, as I said, just produces income, but we also look at a large portion of it as a depreciating asset. Now, what's a depreciating asset? It's an asset that could lose value over time. Now, to compare that to most people's day-to-day life, a car would be a depreciating asset. Sooner or later, it's going to make you money, but it also will deteriorate in value over time. A cell phone would be another good example of this. So this is literally a placeholder because we make our money against this with selling our own options. But this side, we want to produce as much capital as possible. Now, the reason why these dividend trackers are not good is because things like yieldmax that have changed their structure recently. You'll also notice that the curve funds in here have changed their structure recently. And also because the rotational of the yieldmax funds to where they pay weekly, but they don't pay the same week every month. It's a round robin circle. Now there's 52 weeks in a year, so that doesn't break down evenly over 12 months. This is trying to figure out monthly, which it says the dividend yield is 68.11 and the yield on cost is 53.15. And it says February income is 55.20. But I have done all the math on this multiple times, every single stock, rounding everything down, and it comes out to 6,400 monthly. The reason why there's a discrepancy there is you're actually getting 13 payments a year from every yieldmax fund. That's the discrepancy. So the true number a month would be 6,500 a month. Now we are adding to this, so it is going to grow, and they don't all pay the same dividend every time, or distribution, whichever word you'd like to use. So going forward, you need to understand that these numbers are actually skewed extremely low on these trackers. So if you have any of these funds and put them in, it will not track them 100% correctly. I have talked to creators of this and the creators of Snowball. They're working on it. There's just never been anything that's done this before. Now, I'm going to go ahead and jump over to the calendar to show you what I mean before we go into each one of the assets one by one. All right, now we're over in the high yield dividend portfolio calendar, and I'm going to show you exactly what I mean. So when I press there, it says there's the curve ETF. So they have started getting them in the right place because the 6th of this month would be TSLP, which is correct. But they don't have the following Thursday as AMZP. So that should tell you that they don't have the curve funds fixed in here. Secondly, if we go here, you'll see that it says that there's coin, fiat, round hill, and the MAG 7, YMAG. It's important to remember it says YMAG there because that should be paying every Friday, and it's not showing it. Every Friday I hit, it's not showing it. So now we have already lost 3 payments from YMAG on the monthly. It's not showing. And all these pay on Friday. And for some reason, it's got it over here on Tuesday and Wednesday. So their calendars are just messed up. They can't keep it in order. Like I said, I round down. It could be said pretty easily that we'll make $7,000 a month from these distributions, but I like to round down. So let's get back to the portfolio so I can show you guys all of the different investments we're in and why. All right, back to the portfolio. And let's just start right here at the top. Rec shares, AIPI. So we have 40 shares of that. I've got a good cost basis on it, but this is one of those ones that pays very steady. This is our step down to safer investments. It was the rec shares right after yieldmax. So we built from the largest to the lowest, and we are continuing to go down to hold safer investments. So with that 40 shares, it has almost a 35% dividend yield and has been absolutely amazing. So next one down is Curve and their AMZP fund. Now, we just started acquiring Curve funds. They went to a rotational weekly as well, but they pay on Thursdays. They announce on Tuesdays, but theirs are going to be set weeks. So there won't be 13 payments, just 12. Very basic, very safe funds. They sell a little farther out of the money, and they hold up their NAV better. They hold up their value and share price. That's where you'll have problems with some of these covered call funds because they want to generate so much capital, but the NAV, the actual share price, goes down the hill. And you really want to try to stay away from that. That's what we mean by depreciating asset. Now, the way we sell with this portfolio, you could have anything in here. We were just trying to get retired as soon as possible because time's the one thing you can't get back. You can always make more money. Time's what you can't get back, guys. So moving forward, the next one is Coney. So we have 1,175 shares of Coney. The current price is $21. So we've lost some equity in this because our share price that we paid for this, our cost, is very high. But it's been paying almost $1 continually every single month. That's $13 a year. So it's not going to take very long if we haven't already paid it all the way back. So with 1,175 shares of Coney, that brings in about $1 per share every month, pretty much continuously. Next is FEPI, which is another one from Rex. This one has a 25 to 22% yield, depending upon. It's pretty steady. It's more about the share price that changes the yield. But we have 270 shares of that, and that has been one of our best buys, in my opinion. I think that we got it at a good price, and it just pays continuously. Now, the next fund is Fiat. And this is an inverse fund. They'll call it a short fund. They'll call it whatever. Basically, it is the mirror image of Coney. If Coney's going down, Fiat's going up. If Fiat's going down, Coney's going up. It's a way to hedge. And generally, I think all these funds, these short funds, these inverse funds are all junk. And I didn't listen to myself. I got brought in on when the yield was big at the beginning. I made a mistake, and this is the worst investment in our portfolio. But generally speaking, it still pays okay, and we're going to let it pay it off rather than sell out of it. And then after that, whatever we get out of it will just be icing on the cake. But you make mistakes, and you have to decide to sell out and move that money, or to suck it up and let it pay you back. And we've decided to let it suck it up and pay it back. But as you can see, the share price is now at $7.55. It's pretty much stayed there. But most of those shares were bought for about $17 or $18. So yeah, we took a hurting on that one. Next one is honestly any high yielder's favorite, which is Misty, MSTY. Now we have 1,047 shares of this, and it brings in about $2 a share pretty consistently. Now in November and December, I believe, it actually paid $4 a share. So when you add it all together, our first 700 shares of this we bought, we've already gotten our money back from. You heard what I just said. The first 700 shares of this we bought, we already have all of our capital back. It's paid us all that money back. And we're well on to having the rest paid back. So with that in mind, we already have all of our money back, and it's still spitting $2 every month. So you can see why Misty is an absolute beast and just pays us consistently every month. Now the next one is Nvidia. Once again, depreciating asset, but all it needs is another big run up in the market and the share price will be back to where we got it. I think our cost basis is somewhere around $24 and it's at $20.51 right now. Now, Nvidia pays anywhere from 75 cents to $1 pretty much nowadays. So we're still making great income off of it and we have absolutely no issues with it and no intentions of selling ever. Now the next one's SMCY. This is based on SMCI, the company. They've had a lot of problems lately. This is also one of yieldmax's newer funds. So we put forth enough money to get 50 shares when it was falling. And it hasn't done a full recovery yet, but I'm almost back to flat share price, basically what I paid for it. And it's been paying about $2 consistently since it started paying. So I have no complaints about it. I don't plan on selling it. I don't expect it to be a great performer. I just expect it to spit that cash over and over and over. So TSLP is the next one. This is a curve fund based on Tesla. So its share price is going to bounce around. So I have no real concerns about it. They're selling far enough out of the money that it can recoup itself and reacquire some of that share price, because covered call funds really have a hard time once they go down the hill to get back up. But it's only 5 shares. We are building these curve positions. All 4 of them are going to have one stock, one for each week, and we're going to build them up to about 50 shares each just to strengthen our portfolio. Like I said, they hold share price generally pretty good. All right, next one is TSMY. That's a yieldmax fund. We have 62 shares. That would be built up to 200 shares. And what that does is Group A distribution. We only have YMAG paying us right now. I don't like many of the other funds in Group A. This was like picking the best of a bad bunch. You know what I mean? You can look at a batch of apples and see a bunch of them are bad and you try and find one that's the least bruised and that's the one you're going to buy. Same thing. So this just gives us some more during the Group A weeks to make some money. Next is my woman's XDTE. She loves XDTE. She's got 100 shares. This thing pays her anywhere from $17 to $25 every single week. So that's 52 weeks a year. You guys can do the math on that. Now, the way it tracks here, it's showing it at the yield being lower than it actually is. It generally performs about 24-25% a year. And I got to say, this thing is just steady. It holds around that $50 share price. It's pretty much capital flat. I got no complaints. YBTC is 1 share and it's a holding share, so I can literally watch how the price movement of what I paid for it moves against Bitcoin. When Bitcoin moves, any of these Misty, Coin, Fiat, YBTC, whenever Bitcoin moves or crypto moves in a large way, they move. So I bought this share that way I could just gauge how much this moves, because this is a round hill and they usually sell farther out of the money. But I want to watch how much it moves with crypto. Now, the last holding here is really controversial because YMAG doesn't get the love that its older brother fund, YMAX, gets. But YMAG is based on the Magnificent Seven. So you have basically the top 7 companies and in the S&P 500. And then they put that up against yieldmax, which is basically a spread of all of yieldmax's funds. Now, while yieldmax at times pays more, the share price holds up way better in yieldmag over time, which is what I'm looking at. So that's why I have 1,100 shares of it. All right, most of my shares are at about $19. We just got paid, or the distribution was just hit. So that's why the share price is down, plus the market's been down. But it will recover. I've watched it do it every single time. This is a weekly payer, so we just consistently get that income every single week. So now that you've gotten to see our portfolio a little bit, I think you can understand how I say this is an aggressive portfolio. If you research these companies that are putting out these high income covered call funds, they are there to generate you cash, capital. But if they generate you too much, then it will make your share price decline over time. But even like you buying a car to go to work every day, you realize that over time you're going to lose money. The point is to have that car get you to your job or to your business to make you money. And that's kind of what we're doing here. You could do the same structure of what we're doing and fill a portfolio with index funds, which are super safe, and then sell against those. But you're not generating any cash over here. You'd have to sell something, and then your portfolio would go down. So it's kind of about how you want to do it. You could also use less aggressive funds, but in order to create the same amount of yield you are over here, you would need double the money. With index funds, you'd probably need 4 times the money. So as you can see, it's all about balance and risk. Now, I don't want to say that this is how we are going to run our portfolio forever. Once we hit about 59.5, which for my wife is about 10 years, it's time to start thinking about tax efficiencies because all of our retirement accounts are going to open up, and she'll be bringing you videos about those. And those numbers are going to blow your mind because we're selling options in our retirement accounts to make them grow. Now, a lot of people are going to say, you guys are insane. I can't believe you're doing this. Let me explain this to you in a different way. This portfolio, even with the low numbers it's showing, is showing like a 60% yield. All right. We basically make $10,000 a month off options that we sell and these dividends. That's like our average. That's what it looks like on paper. Every time I do the numbers, estimates, that's what happens. So from dividends, we're making about $6,500. From options, we're making anywhere from around $3,500 to $5,500 a month. So let's say it's 10 grand just for an average number. So 60, 40, 10 grand. 10 grand over 12 months is $120,000. Our portfolio is $120,000. So what I'm telling you is we are making around a 90%, maybe even 100% return a year on our money. So while I know it's extremely aggressive, if you're losing a little bit of share price as it depreciates, or a lot on certain funds, because you have to be careful which funds you pick, because I'll be honest, a lot of yieldmax funds are trash, like fiat, like the inverse funds that I told you about. You get into too many of those, this system won't work. But if you do your research and you pay attention to the market, you'd be surprised what you can produce. Now, I don't want to tell anyone to go do this, because none of this is financial advice. But I'm going to say that there are other people that I'm sure will be willing later to come on to this channel and talk to you guys that are recreating this same structure, doing it themselves. And those people are actually sometimes outperforming us. All right, because they're not afraid to go look at the market and do things a little bit different. The reality is this structured so we could retire now. Now, we also don't have any debt. Both of our properties are paid off. So we get to live this life because we made good decisions. But I can tell you this, you want to be wealthy, start investing now. You don't have to invest in what we do. Make sure your 401k is getting invested in if you have one at your job. Make sure you're getting that match. If you don't, go open an IRA, open a taxable account, invest in index funds. I don't care what you do, pay down debt. Maybe that's a better use of your money right now. But you have to do something to move forward. Now, I will be doing a video next on selling options, so I can actually show you how we do it. And then Missy's working on videos to share how we are creating income inside of our IRAs and HSAs and our Roths, just to show you how we are creating income inside there. That way, when it's time to retire, the money's there. And she's even working on a strategy inside one that if we wanted to do an early withdrawal, even though we're making well over $100,000 a year, we can go ahead and take that out, even with penalty and everything, at 30%. Now, some of you may be like, that's crazy, you're giving up 30% of your money. Go look at what people pay to have early pulls from their IRAs. It's way more than that usually in penalty and taxes. So we have backup plans upon backup plans, and I'd like to share them all with you. I'd like you to show exactly how we're doing all this, and then maybe you can build your own structure, or maybe it'll just give you ideas to go learn something, because this is just the tip of the iceberg. We took some time, we learned about options, we learned about money, and we learned about how to put the two together to create early retirement. Now, at 47 years old, yeah, I'm 47, and my wife, who just turned 51, happy birthday, baby girl, we're living the life we want to live. Do we not work? No, we still work. A lot of times I'm working for free here around the farm in the homestead. Sometimes she still wants to go out and hang out with her friends down at Walmart Spark and run some orders. It never said we had to stop working, but we have the choice not to, because there's a foot of snow and ice sitting outside our door right now. And you know what? We don't have to go do nothing. Our bills are paid, everything's taken care of, and we're happy. And that's what financial independence is about for us. Now you need to find out what it's for you. So let me know down in the comments what you think of the portfolio. Do you think we're insane? Let us know. I'll be glad to listen to it. If you think there's any chance we're going to fail, make sure you subscribe. Because I really would like to enjoy proving you're wrong. Because failure is not an option. But if you think we'll succeed, you should subscribe too. Because I think that you can do it as well. And with that said, I'll see you in the next one.